Welcome to the new folks joining us for the business update. I am Valerie Middlebrooks, a director in our tax and small business department, and I am joined by two of our principals also in the tax and small business department, Mike Kelly and Carly Laughlin. So I would like to turn it over to Mike to kick us off with the Inflation Reduction Act.
Thanks, Val. So let's just talk about the business components of that act this time around. Next slide. Okay, so we talked about a clean vehicle credit for individuals. It was a $7,500 credit for individuals. There's also going to be a credit for vehicles that meet the criteria and used in a trade or business. The credit will begin next year, and it's going to be calculated based on the lesser of 15% of the cost of the vehicle or the incremental cost of the vehicle compared to the same type of vehicle that is solely powered by gasoline. The IRS is going to have to put out regs on that, I believe. And then after that, hopefully the dealer and IRS can kind of sort that out and leave us CPAs out of calculating that incremental cost. But if you buy a vehicle that is not a hybrid, that is powered solely by plug-in electric, then the credit could jump from the 15% to 30%. Like that, the vehicle that was we talked about during a personal income tax section is also going to be a $7,500 credit. The cool thing here is if the vehicle that you purchase is more than 14,000 pounds, you could be eligible for a credit up to $40,000. And this credit, like all those other credits we talked about during the last session, expire at the end of 2032. Next slide. So what is a qualified commercial vehicle? Basically, it's got to be used in the trade or business for you to claim a credit. You can't just like we talked about during last session. It can't be a component of inventory. You can't collect a bunch of cars and take credits on them and hope to resell them. The same 7 kilowatt hour capacity for the battery applies unless you buy a vehicle that's more than 14,000 pounds and you have a 15 kilowatt hour capacity. The one thing to note is, again, it's got to be used in trade or business. And when you buy a vehicle in a trade or business, you can claim depreciation on that vehicle. But if you take a credit on a vehicle, that should reduce your cost basis in the vehicle when it comes to depreciation. You can't double dip. You can't claim a credit and also claim depreciation deductions on that portion of the credit claim. So just one thing to keep in mind, you will lose a little bit of a deduction when you buy a vehicle that's eligible for the credit in a trade or business. Next slide. The next few slides here are going to be miscellaneous credits that were either introduced, extended, enhanced, but a lot of them are not going to apply to our everyday clients. A lot of these credits are focused on energy storage, production, transfer of energy. I don't really have any clients that are building nuclear power plants. So a lot of this stuff is not going to apply to most of our clients, but go down a slide or two, please. There are a couple. One more. There's a couple credits here that may apply to our clients. The second bullet point from the bottom, the accelerated cost recovery for green building property. This credit's actually been around for some time, but essentially, if you make certain improvements to the property that you are either you lease or that you own, and if you reduce the cost of energy by 25%, you may be entitled to some accelerated cost recovery. Okay, that limit used to be 50%. So in the older, before this Inflation Reduction Act, if you reduced the cost of property by 50%, you were eligible for this treatment. So keep that in mind if you're making heavy renovations to your building or property. Get some sort of energy study done, and maybe you'll be eligible for some advanced deductions. The other item that could be applicable to our clients is a credit for your contractors that build homes. And this one I think has been around also for a while, but it's been enhanced. And long story short, if you're a home builder out there and the homes you built meet certain energy requirements, then you might be entitled to a credit of $5,000 per home built. Next slide. The Inflation Reduction Act also reintroduced the corporate AMT, alternative minimum tax. This was eliminated, I think, back in 2018 when the TCJA was passed. It's a 15% minimum tax on your financial statement or your book income. This is probably not going to apply to most of our clients. You need to have an average of $1 billion of book income in order for the AMT to impact you. I would only say if there's any CPAs in the audience, be careful with the affiliated party rules. So if I'm an owner in a group of entities that are related, I might have to combine the income of all those entities. I have one particular client that is a subsidiary of a foreign publicly traded company. I'd probably have to look at the financial statements of that foreign company to get comfortable with whether they are, they could certainly be above the $1 billion. So I got to get comfortable with it. If they are above the $1 billion, then that's going to potentially pull my the subsidiary of that entity into the grasp of AMT. This is effective next year. Next slide, please. This will be another one that's probably not going to impact our clients. I think it's kind of interesting just to be aware of it. The Congress has imposed a 1% excise tax on the repurchase of corporate stock. So if you're familiar with your investing, you will have your the companies, instead of maybe issuing dividends sometimes, or maybe in combination with dividends, they will repurchase stock from the that are outstanding. The thought process is it's going to create value for the shareholders. The less stock out there, hopefully drive the price of the stock up. At the very least, it's going to increase your earnings per share, since there's less shares out there. A lot of people measure when they're valuing stock the earnings per share. Congress didn't like this. I guess it was kind of, again, you're increasing value for the shareholders, but the shareholders aren't getting taxed like they do on dividends. So instead of taxing the shareholders, they're going to tax the corporation with a 1% excise tax. If you have a 401k, unfortunately, I view this as a backdoor tax on your 401k that a lot of people just don't know about. So thought it was worth mentioning. This is effective at the end of this year, or next year, I should say. Okay, so I'm going to turn things over to Val. She's going to talk about some updates with pass-throughs.
Next slide, please. So Schedule K2 and K3. We had a lot of fun with these last year, and it looks like we might have a lot more fun with them this year. And so I'm going to, because they were new last year, and I believe at the time of this presentation last year, we might not have had any regs, or any instructions, I should say, not regs, on these forms. So I'm just going to do a little background, and then I'll talk about where I think we are today on the K2, K3. So this reporting, these forms were initiated for the 2021 tax filings, which was last year. And the reason they were introduced was to report items of international tax relevance. and they were meant to replace things that had previously been reported on lines 16 and 20 of Schedule K or Schedule K1 for pass-through returns, primarily partnerships, but they do apply to S corps also, even though I guess it's more common to see it on partnerships, especially partnership investments in publicly traded companies. The K2 is sort of a partnership level form, and it is meant to be an extension of the Schedule K in the Form 1065. And the Schedule K3 is meant to be an extension of a Schedule K1, which is the form that gets sent to the partners to pick up their share of the applicable items. The IRS said these forms were necessary to provide consistency of reporting to all, partners and shareholders, and to accommodate some of the additional complex reporting requirements that were instituted under TCJA. So I believe at the time we did this presentation last year and even into the beginning of tax season, so January, there was a lot of uncertainty as far as, number one, who needs to comply with filing these forms, and two, what actually needed to be contained on these forms. So we had kind of a fun tax season trying to figure out whether the partnerships actually needed to file them. One of the things that is paramount in this analysis is whether you actually have items of international significance. And what the IRS means by that is, do you generate any foreign income? Do you pay any foreign taxes? Or do you have any partners who are foreign? And so we were looking at, if you didn't have any items of international significance, did you even need to comply with this requirement? Ultimately, the IRS, I think through the instructions for these forms and possibly through some frequently asked questions, basically said, if a partner or shareholder is claiming a foreign tax credit on their individual tax return, they need this information from the pass-throughs. So they need to understand the gross income that's coming from the partnership and whether it's foreign or US source, as well as the deductions coming through from the partnership, which again, are the US or foreign source, as well as if there's any foreign tax credit being passed through to the partners. So that made it difficult for us to determine whether we actually needed to file these forms or not. And I think in a lot of cases, we took the position that we were going to file the forms because it was unclear to us whether the shareholders or partners actually needed this information. So fast forward to about a month ago, which is really not that long, considering that we will be starting another tax season in one short month. The IRS came out with new draft instructions for these Schedule K2s and K3s. And those draft instructions did contain clearer exceptions to when a partnership or S corporation would not be required to complete and file these K2 and K3s. So the original draft instructions said that you would not be required to file them if you met basically four exceptions. The first being that the partnership or S corporation had no items of international significance. And what they mean by that is they had no foreign activity, so no foreign income, no foreign expenses, no foreign tax paid, or no foreign partners. They also added you could have a little foreign activity and still not have to generate these forms. And by a little foreign activity, they defined it as $300 or less of foreign tax paid at the partnership level. The second exception was, okay, so that's actually two exceptions, the first two. One, they had no foreign activity, and two, they had no foreign partners. The next test would be that you had to notify. So partnerships or S corporations would have to notify their partners that they would not be, that they thought that they had no items of foreign significance, and they would not be filing these forms unless the partner or shareholder requested. The rules around that was the notifications would needed to have been provided to partners or shareholders by January 15th, 2023. And those partners or shareholders had 1 month to notify the partnership or S corporation that they needed this information. And if a partnership or S corp was notified, they would have to file the forms with their tax filing, as well as providing them to their shareholders or partners. This weekend, which we love when this happens, this weekend we got new draft, again, still draft, so this could change again, I think, instructions for the Schedule K2 and K3. They changed these 4 criteria, I think, to make them easier to comply with. And so the first 2 tests remain the same. So no or little items of foreign significance and no foreign partners. But they changed the notification requirements. And now the notification requirements, and I'm just going to read them because I still find them a little confusing. So for partnership notification, it says, with respect to a partnership that satisfies criteria 1 and 2, which you have no items or no material items of international significance and no foreign partners, the partnership notification from the partnership is done on the Schedule K1 when you furnish a Schedule K1 to the partner. So basically, the notice can be provided on an attachment to the Schedule K1 or a footnote saying that you will not be providing the K3 information unless the partners request it. Then the partners, then the 1 month rule. So instead of notifying the partners before you file the return and them having a month to respond to it, now the partners can follow up with the partnership after they receive the K1 and request this information. And once a partner does request this information, then the partnership essentially has 1 month to provide this information to the partner. Now, however, you only have to provide it to the requesting partner. You don't have to go back and amend your return to include this with your IRS filing. You just have to give it to the partner who requested it. So, again, this continues to be very confusing. Do we have to file it? Do we not have to file it? What do we do? Kind of a thing. But this is basically where we're at today, which is that if you have no foreign activity or little foreign activity and you have no foreign partners, unless partners are requesting this, we're probably not going to have to file these forms, but we will have to disclose to partners that they can request the information if they need it to file their personal returns. Next slide, which Carly, I'm going to turn over to Carly. She's going to cover the additional pass-through.
Sure, yeah. Val, I thought it was funny because you were talking about how you're covering things that came out this weekend. And even while we're on this call, I'm seeing updates come out about Delaware might be allowing a deduction if you contribute to a 529 plan, and that's coming out today. So
yeah.
So there's always, it's kind of funny because things are always changing day to day. And so you got to stay on top of it. All right, so I'm going to talk quickly about one recent campaign initiative that we're seeing the IRS have, which is the topic of basis. So now for this purpose, we're talking about basis tracking, specifically when applicable to partnerships and S corporations. So tracking your cost basis in these types of entities really become crucial because your basis will fluctuate year to year, and that can make a significant tax impact on the activity itself. So to quickly oversimplify the calculation, your basis essentially it increases for contributions and net income allocable to the member or shareholder, and it'll decrease for distributions or net losses. Your basis can also be impacted by things like qualified non-recourse debt and recourse debt that's allocable to each member and shareholder. So it can get a lot more complicated than that, but that's just a very simplified overview. The IRS essentially requires each member and shareholder to calculate and trace their basis each year. S corporations are actually required to S corporation holders, I should say, are required to attach on their individual or fiduciary income tax returns the actual basis tracking schedule, when losses or distributions are being reported. It can be really difficult and time consuming to go back and retrace historical basis. So it's really just a lot easier to start tracking it from day one of the entity formation. And there have been a lot of, we've been seeing more instances where the IRS is requesting to see tax returns, historical tax returns from many, many years back in order to prove the basis for in those S corps or partnerships. That's something that you want to think about when you're talking about document retention policies and how long do you want to hold on to tax returns. Well, if you have, a lot of years of losses or distributions, that's something you want to think about and holding on to them longer than maybe you naturally would. You also want to be careful here when you are investing in private equity hedge fund partnerships or publicly traded partnerships through your investment firms, because these types of investments, it's very likely that the cost basis that you see on your monthly statements is not accurate, because it's not reflecting the year-to-year adjustments for the income and the losses that are being allocated each year on that K1, that form K1 that gets issued to you, or the distributions even necessarily. So it can lead an investor to think that they might have a gain on the sale of something or a loss on the sale of an investment, when in reality their cost basis is very different than what those monthly statements are saying. So you just want to make sure, that you're tracking your basis if you are invested in one of these pass-throughs, and that you're aware of what that basis is, so you can make intelligent decisions on when to sell. All right, next slide. Okay, we have the 754 election update. I believe, so this is kind of just an administrative item. This really won't impact, many people. Just essentially told an update that said the taxpayer no longer had to actually sign the election form. So nothing major changed there. Next slide. Okay. Mike's going to talk about the pass-through entity tax, which also has a recent update.
Thanks, Scarlett. Just a quick refresher on what this pass-through entity tax is. The TCJA, when that came out, I think 2018, it limited the amount of state income taxes that someone could deduct under Schedule A, income and real estate taxes, $10,000. So a lot of the states that had high income tax rates didn't like that. They thought this was unfair. So they started doing these workarounds. And basically what they did was, for their pass-through entities, well, let's talk about the pass-through entities, the flow of income there, and make sure everyone understands that. If I'm investing in a partnership or S corporation, the income flows down to the shareholders 1040 and is taxed there, okay? But it doesn't get taxed at the entity level typically for these type of flow through entities. So what these states did when they heard about this $10,000 cap and got upset about it, they started allowing their flow through entities to choose to get taxed at the entity level. Instead of letting the income flow down to the state return, they were like, go ahead and pay us the tax at the entity level, treat this as an entity level tax. And if you treat it as an entity level tax, then you can get a deduction at the entity level and you can avoid this $10,000 cap. So states like New York, California, New Jersey, I think there's like over 20 states that have adopted some sort of system. Every system is a little different, which gives us a little headache. Have adopted something like this, and the IRS has pretty much said there's no way we can fight this, and they have pretty much thrown their hands up in the air and said, go ahead and do this. It's got to be worth your time to do it. There's got to actually be some sort of tax savings. I do it for one client who operates in California. I'll probably save him like $5,000 to $7,000 a year by doing things this way. The AICPA. This slide was originally focused on the AICPA. Just wrote a letter to the IRS this year trying to get some clarification on certain items that the IRS put out. I won't bore you with those details. I think the more important thing is, be aware that if you have a pass-through entity that operates in these other states, maybe consider doing an entity level tax. It's got to be worth the time though. It can't be to save a couple $100 because there's research on our end that, you know, we had to figure out how to do this because every state's a little bit different. We just saw, I think yesterday, that now Delaware has some sort of legislation, potential legislation coming out saying you may be able to do this. And I quickly looked at it. So don't hold me to this, but I think I saw that the pass-through tax for Delaware, it's going to be some around 8.5% or something, or maybe 8%. And the normal tax rate at the individual level, the max tax rate is 6.6. So it looks like, you know, Delaware is trying to potentially take a couple dollars, put in their pocket to give you this convenience of saving tax on your end. So, you know, we'll keep an eye on that and just kind of be aware this stuff's out there, especially if you have pass-throughs that generates significant income while operating in these high tax states. And I'm going to turn things back over to Carly, who is going to talk about some S Corp stuff.
Okay, so the IRS also released a Rev Proc this year that talked about relief procedures if you essentially are not following the S corporation rules. So whenever an S corporation status is elected, shareholders have to be really careful that the entity meets all the defined requirements to be an eligible S corporation. Because if it fails to meet those requirements and the entity is essentially blown the S Corp election and it's going to be forced to be taxed as a C corporation, which can create some big problems. So you want to be very, very careful here. One of the requirements to be in being an S corporation is that there's only one class of stocks. So there can't be anything that even resembles preferred stock mentioned in the operating agreement for an S corporation. And owners can't have different rights. So, you know, if you have two owners that are 50-50, you know, and if one of those shareholders gets $20,000 distribution while the other shareholder doesn't get anything, that'd be a problem because you have disproportionate distributions. And you could potentially blow your S Corp election that way. So, you know, and a lot of times, a lot of these issues are really discovered when the S corporation is selling out to another company. When it's being sold to somebody else or maybe a bigger company, then a lot of times the buyer is going to be doing their due diligence to make sure the S Corp is still in good standing, and they're kind of digging through the operating agreements and things like that. And they might find that something, you know, does not fit. And then if it does not fit, then they have to actually request a private letter ruling, which costs like $10,000 to get the official blessing from the IRS to that it does remain an S corporation and won't automatically become a C Corp and taxed as a C Corp. So, you know, that can be really costly and time consuming. And the IRS essentially got so many of these private letter ruling requests that they release this Rev Proc that creates some procedures to get relief for potentially doing some of these things and trying to fix them by following the procedures. So we're going to just highlight a couple of them. So for example, a couple of them are, you know, disproportionate distributions. You know, they're essentially that could result in two different types of stock that could be seen as resulting in two different types of stock for, but if the governing document provides identical distributions and liquidating rights, then there are relief procedures there that you can follow. Also, if you know, make an error on your form 2553, that's the form that you actually filed to elect to become an S Corp. If you make some errors on there, well, there are some procedures that you can follow in this Rev Proc to kind of correct those errors. And the IRS is saying, you know, we're not going to issue any private letter rulings unless you try to follow and exhaust everything in this Rev Proc, these relief procedures first. If none of them fit, you know, then you can come to us, but you first have to go through all of these steps to try to fix what you've done. Another issue here, if you go to the next slide, another issue here is potential, and the very next slide, that's 2553. The very next issue is maybe you have a governing document that implies that there could be a second class of stock. You know, we see this often occur if you have a partnership that then goes forward to elect S Corp status. that old partnership agreement was never updated when it became an S Corp. So that's kind of something that you want to think about if you are going to make the S Corp election. If you're thinking about it, you always want to have your agreements looked at over again to make sure they're in conformity. But if you do find yourself in this situation, the IRS has also created in this Rev Proc some procedures that you can follow to try to fix this. In order to qualify for that, you couldn't have done any disproportionate distributions, and you have to be filing your 1120S on a timely basis. And most importantly is that you have to find out that you have an issue before the IRS does. So you need to apply for, basically apply for relief before the IRS comes and points that out. So this is kind of just a good reminder also to say, hey, if you do have some issues, there may be ways to fix them, and get it done before the IRS finds out. All right, next up, Val is going to start off by talking on some foreign elements.
Next slide, please. So this, I'm not going to go into all this in detail. This is just sort of like a shorthand for if you are a U.S. person, including businesses are included under the definition of U.S. person. With any foreign connections, there could be, a slew of things that you might have to be aware of to file with your returns. So the general idea being that if you have accounts in a foreign country, if you have assets in a foreign country, if you are owned by a foreign corporation, or if you own a foreign corporation, or if you do business in a boycott country, all of those things could require some sort of disclosure. Oh, and I forgot, you also, if you transfer either assets included or cash to a foreign entity, you might also have to disclose that. So just kind of in general, know that if you are partaking in any of these sort of activities, there may be things that need to be filed with your tax return. And this sort of gives you the shorthand for, okay, I've got this situation. Okay, maybe I need to look at Form 926, or maybe I need to look at Form 5472. And also, if you have transactions with foreign entities, especially foreign related parties, those are things that will have to be disclosed. In the individual session, we also highlighted sort of this foreign financial asset or foreign bank account reporting. I want to reiterate that this is not just an individual requirement, it is also a business requirement. So what we commonly call the FBAR, which is technically FinCEN Form 114, which requires reporting of foreign bank accounts if that account exceeds $10,000 at any point during the year. And that includes not only if it is your bank account, but if you have a signature authority over a foreign account, it also needs to be disclosed. The related form is a Form 8938. This does also apply to businesses, but in very limited circumstances. So a business would potentially have to file a Form 8938 if it was a closely held business and at least 50% of its activity had passive income. So essentially investments. So if you have an investment partnership that has significant foreign financial assets, which includes foreign bank accounts or foreign investment accounts, you might also have to file a Form 8938. And as always, with all things foreign, all of these forms carry very, very hefty penalties, mostly starting at $10,000, some starting at $25,000, and sometimes multiples. So if, for example, if you should have filed, 3 Form 5472s, it would be $25,000 per form. So these are the kind of things that you don't really want to mess around with. The IRS, these are easy things for the IRS to pick off and send you, huge notices. So make sure that if you have any of those things, you talk to your Belfint professional or whoever your tax professional is, so that you don't get in this situation. If you want to go to the next slide, and to illustrate how important the IRS takes these things, Carly's going to go over some of the cases that we saw in 2022.
Yeah, so as Val had mentioned, you know, we typically associate FBARs with individual tax filings, but it's very, very much applicable to businesses as well. So you got to be careful there. I have some court cases listed here about failure to file FBARs. So I had mentioned our first session that the failure to file FBARs can kind of fall under one of two different categories. They either can determine that you were willfully not filing, in which case the penalties is much more harsh. It is the greater of $100,000 or 50% of the foreign account balance. There can be very, very hefty. The other category is the non-willfulness. So if you are not filing an FBAR, but it's non-willful, then the penalty is $10,000. So here on the first slide, we see a couple court cases. All of these actually were current year court cases about willful failure to file FBAR. Some of them, the IRS was successful and some of them not. But the key thing that I want to get across here is that this is something the IRS is pursuing. It's, you know, low hanging fruit for them. They can get a very large amount of money out of these cases with penalties that high. So you have to be very, very careful. I don't have enough time to go over all of them, but I do want to just touch on the second one, because I thought that was an interesting case and a little bit sad, but had a little bit of a happy ending. So the taxpayer in that case was about 100 years old. He had an elementary school education and was a Holocaust survivor. Most of his family had died in World War II, so he had gathered his family wealth into a bank account in Switzerland. And he put it in Switzerland not because he was trying to hide money, but because he thought that that was a neutral country and that would be where the money would be safe if another world war were to break out. And so that bank account actually grew to about $17 million by 2007. So that taxpayer moved to the US. While he was in the US, he heavily relied upon a CPA. That CPA to prepare his taxes. The CPA never asked about foreign bank accounts and, you know, therefore never filed an FBAR. One thing that I wanted to note about this case was the tax court did point out that on all individual income tax returns, there is a question at the bottom of the Schedule B that says, do you own a foreign bank account? And the software that the CPA was using in this case automatically marked that question no, which is very common for tax preparation software. So they marked it no. The taxpayer didn't notice, didn't think anything of it because it's just a little small question at the bottom, overlooked. And the IRS said that this was therefore a willful failure to file FBAR because that question was marked no, saying, no, I don't have any foreign bank accounts, when indeed he did. So the IRS said, they actually went after failure to file for 2007 and charged about $9 million in penalties. This case went to the District Court of New York, and the District Court actually disagreed with the IRS and said that this was not a willful failure to file because the taxpayer was not managing that foreign account. They weren't, actively investing. They really just kind of set it aside and didn't touch it. The taxpayer also did not know of the requirements to disclose the fund, and that the taxpayer, was not informed by his CPA that he had the FBAR filing requirement, and he heavily relied upon his CPA. And just because that question was marked no for having foreign bank accounts, that was an automatic software fill in. So the district court, kind of gave him a break here and said that it wasn't a willful failure to file. So that significantly reduced the penalties in this case. So it had a happy ending, but it was interesting to see how aggressive the IRS is going to be taking the definition of willfulness failure to file. All right, if you go to the next slide, we have two cases here that were from 2021, but they're extending into the current year. These are both based on non-willful failure to file penalties. The important takeaway here is, if you recall, I had said that there is a $10,000 penalty for non-willful failure to file, but what's in question between these two cases is it $10,000 per form that you failed to file, or is it $10,000 per foreign bank account that you failed to report? And that can be a very drastic difference for people who have a lot of foreign bank accounts. In the first case here, you can see that took place in the Ninth Circuit, and that taxpayer had 13 foreign accounts. And so the question that came up was the IRS was trying to assess a penalty that was per account. So that would have been $130,000. But the district court disagreed with the IRS and said, nope, it's just penalty per form. So it was $10,000. And the Ninth Circuit agreed. So we had that. However, in the next court case that took place in the Fifth Circuit, again, they were looking at how do you imply the $10,000 penalty, or is it per account, or is it per filing? And the IRS again chose to go by per account. So the penalty was $2.72 million for this particular taxpayer. And the Fifth Circuit agreed with that, how that penalty was calculated. However, this was taken now to the Supreme Court. So the Supreme Court has agreed and is going to be commenting on this probably very soon on whether how that $10,000 penalty should be implied. So this is something that we're going to be following, and you can see here in these examples that it does create a drastic difference.
So next slide, please. I'm going to cover section 1202. This is not new, but for whatever reason, this has seemed to have a resurgence in 2021, and we've gotten actually quite a few questions about it. So I just kind of wanted to go over what this is. This section 1202 allows non-corporate shareholders, so individuals, to exclude, so this was the original guidance, exclude 50% of the gain from the sale of qualified small business stock. So for short, QSBS, that had been held for a minimum of 5 years. Further legislation as the years went on increased the exclusion. So the exclusion was increased from 50 to 75% for stock acquired from February 18th, 2009 to September 27th, 2010, and then increased one more time up to 100% exclusion for small business stock acquired on or after September 28th, 2010. One thing that I think sort of falls through the cracks on these rules is that if the stock qualifies either under the 50% or the 75%, which would mean that the remaining 50% of the gain would be taxable, or 25%, that it's actually taxed at 28%, not the capital gain rate. So I know I was working with a client who was thinking that they may sell their business and wondering what the impact would be on their shareholders. And they were under the impression that whatever gain would be still taxable would be at the long-term capital gain rates, which it's not. So make sure that if you're looking at the situation and you do have remaining gain, that it is taxed at 28%. There are a slew of requirements to qualify as small business stock. There's a C Corp requirement, so it must be stock of a C corporation. The corporation must meet the qualified small business requirements, as well as the original issuance requirement. So it must be the original issuance of stock from the corporation to the shareholder. Next slide. Some of the additional requirements are that the stock must have been issued after August 9th, 1993. So nothing before that time qualifies for this exclusion. There's a gross asset threshold, which is 50. So the gross assets of the underlying corporation cannot exceed $50 million. However, for this purpose, you must combine related corporations. So if you have a group of parent subsidiary corporations, you would have to add all their assets together to determine whether you meet the $50 million test. There are also two requirements that must be met for what the regs call substantially all requirements for the shareholder. And that is that the underlying corporation must have been a C corporation for substantially all of the holding period, as well as the C corporation must be an active business, which means at least 80% of the assets of the corporation must be used in the active conduct of a trade or business. Now, while that seems obvious, I want to note that the list of qualified trade or businesses excludes quite a few things. So things like a lot of services. So health, law, engineering, architecture, accounting, actuarial, consulting, financial services, insurance, farming. I'm not sure why farming is excluded, except I think farming has other special rules related. And the extraction of oil and gas, and hotels and motels and restaurants. So there are a lot of, common businesses that would not meet the trade or business requirement under this particular exclusion. Next slide. And lastly, there are limitations on the excludable amounts that can be taken under the 1202 regulations. And there are two sets. There's a cumulative limitation and an annual limitation. So the cumulative limitation is that you own up to $10 million reduced by the aggregate amount of any eligible gains taken into account under this section in prior years related to this stock holding. And the annual limitation is 10 times the aggregate adjusted basis of the qualified small business stock issued to that taxpayer. Okay, next slide. This is not new also. This is a tax court memo that came out in 2016. And we might have actually even talked about this several years ago, but I wanted to bring it up again because we had a taxpayer this year who actually, the IRS audited their business and they used this same tactic to make adjustments. And so this is kind of a common scenario. So in this case, this tax court memo is about a corporation, which was a law firm. They paid annual bonuses to their shareholders each year to, in effect, zero out their taxable income. The corporation also did not pay any dividends to its shareholders. And what the IRS questioned was whether they were paying reasonable compensation was being to the shareholders. In this case, were they paying too much compensation to the shareholders? And the line of questioning that the IRS used was whether a reasonable investor test was being met. So basically, if you're a shareholder in this company and you're not receiving any return on your investment, because all the compensation is being paid out, to the employees of the company, would that sort of hold up? And basically, the IRS said no. It fails the reasonable investor test. You paid out too much compensation to your employees, and you should have paid a dividend to your shareholders. And in this case, the employees and the shareholders are largely the same. But I just find it interesting that this is still resurfacing all these years later, even after the corporate tax rate has been reduced and the qualified dividend rate still remains low. So I know we all use this as a planning tool, so just be aware that the IRS is still disagreeing sort of with this approach. Next slide. So just a reminder that both 100% bonus depreciation actually will be expiring at the end of this year, and it will continue to be reduced by 20% every year down to zero in 2026. So if you need to buy equipment, now may be the time to do it if you'd like to still get the 100% bonus in 2022. Next slide. Meals deduction. So again, just a reminder, last year, the IRS issued notice 2021-25, which allowed for 100% deduction for meals provided by a restaurant. That was a 2-year provision, which will expire 12/31/22. So at this point, we still have the 100% deduction till the end of this year. However, if the meals are not provided by a restaurant, you're still limited to 50%. And then as a reminder, entertainment expenses are still not deductible at all. And that provision was provided for under TCJA and has not been changed since 2018. Next slide. Okay, I'm going to turn it over to Carly to talk about R&D.
Yeah, so we just quickly wanted to touch on an update about research and development costs. So in 2017, the Tax Cuts and Small Jobs Act was passed, and that act essentially said that R&D expenses would have to start getting amortized starting in 2022, and that would be over a 5 or 15-year time frame. And, you know, last year, if you recall, there was the Build Back Better plan, which Congress attempted to pass at the end of last year, starting the beginning of this year. And in that plan, they had written in that they wanted to remove this requirement that you had to amortize the R&D costs. But of course, that bill did not pass. So as it stands now, everyone should be prepared if you do have R&D costs that you are going to have to amortize these costs. But, you know, there is still some hope that Congress attempts to remove this requirement in early 2023, but we don't know for sure yet. Good. All right. And then the last topic that we're going to touch on today in the 5 or so minutes we have left is the Corporate Reporting Transparency Act, which Mike is going to fill us in on.
Thanks, Carly. Okay, so this is going to be an item that is going to probably affect all our business clients. And I do encourage our business clients to make sure that they pay this special attention. It is some annoying new reporting requirements for pretty much anyone that forms an entity with the state. Even if you form an LLC, corporation, partnership, you may fall underneath this blanket to report certain information to the government. The purpose of this is to crack down on those folks that are taking advantage of you know, the system of creating entities for criminal activities. So, you know, if you create the entity, if you're a beneficial owner of the entity, or you might have to report certain information about yourself, and for the entity itself, you might have to report some information. Next slide, please. Here's the reason why we need all our clients to pay attention to this and participate in this with us. You know, a CPA is generally required to prepare, you know, we're engaged to typically prepare income tax returns or other items. And we're, you know, typically not going to be engaged to do these things. So that's why we need, you know, all our clients' participation in this. But there's $10,000 potential penalty here if you don't report this information to the government. Next slide, please. And this reporting is gonna basically have to be done by the end of 2024. If you create an entity in 2024, you have 30 days after you create an entity, or let me rephrase that. If you create an entity in 2024 or later, you have 30 days to report information to the government. If you make changes to the information that you already reported, you have 30 days to update those changes with the government. So these timelines are a bit unreasonable. Hopefully there's pushback here from someone that, you know, gives a little bit additional time, because it's just kind of unreasonable when they're going to hit you with a $10,000 penalty and only give you 30 days to do something, no matter how simple it is. So keep that in mind. Next slide, please. There is going to be a general exemption for the larger companies, larger company being one that has more than 20 employees in the US, has a permanent place of operations in the US, and has more than $5 million of gross receipts. So for once, you know, usually the exceptions are granted to the smaller companies. Now the exceptions granted to the larger ones, probably because, you know, they already do a lot of reporting already. For example, publicly traded publicly traded companies are exempted from this, probably because God knows how much reporting you have to do with the SEC. And good thing is your nonprofit nonprofits look to be exempted. Next slide, please. So like I said, there's going to be certain information that's going to be reported to the government. It's going to be about the person that files the document, the document of the state to create the company, your beneficial owners, 25% owners, or anyone that exercises substantial control over the entity. There's going to be information regarding these people that needs to be filed with the state. Next slide, please. What is that information that needs to be filed with the state for your applicants and beneficial owners? Nothing too complicated. Name, date of birth, business or home address. And I guess the hardest part is going to be there's going to have to be some sort of identifying number from the passport or driver's license or other form of governmental ID. Biggest challenge I see here is with any of our foreign clients is getting that information and digging down into what exactly they need to provide. For your reporting company, again, nothing too crazy. Name, address, where did you register the business, and the EIN. So this information, again, not too difficult. The 30-day requirement, any changes in this is the tricky part. And that's all I'm going to talk about there. I'm going to turn things back over to Val to wrap things up here. Thank you.
I thank everybody for attending, and I hope everybody has a happy holidays. And for you Eagles fans, I hope things turn out well for you. Thank you.